when you're in this like do it with you sort of lane, things like building empowerment and things like helping a client really have ownership over the decision. A lot of what I'm doing is I'm defining a range of good decisions.
I can't wait to introduce you to Knowing Me, Knowing You, the Know Me podcast where the future of financial advice starts with discovery. We're bringing you candid conversations with top industry leaders, innovators, and behavioral finance experts, exploring how wealth managers can deepen client relationships, personalize advice at scale, and drive real business growth. Because clients don't just want financial plans, they want to feel understood. They want to be known. Stay tuned, subscribe, and get ready to transform the way you connect with clients. Know Me, transforming discovery into growth. Hi, and today we're joined by Natalie Taylor, CFP, a nationally recognized financial planner, fintech consultant, and speaker whose mission is to make financial advice actually work in real life, not just on paper. With over 20 years in financial planning and over 10 years working inside and alongside fintechs like Learnvest, SoFi, Monarch Money, and Ellevest, Natalie brings a rare blend of human-centered planning and product thinking. She's built scalable advice frameworks, coached thousands of advisors, and now leads a modern planning firm focused on mid-career professionals with complex equity compensation decisions. Natalie is also a powerful speaker and storyteller, helping audiences find balance between enjoying life today and planning for tomorrow. Her work is grounded in empathy, behavioral insight, and the belief that better decisions come from better conversations. We couldn't agree more. Natalie, thank you so much for being here. I'm glad to have you on the Knowing Me, Knowing You podcast.
Thanks for having me.
It is a joy, and what a fantastic background you have. Can you please kick us off with what's the most exciting thing to you about the moment that we're in related to the future of wealth management?
Yeah, I think the most exciting thing would be, I think we're in a time where there's the real potential for the rise of like the human forward, client-centric advisor. So that's exciting to me.
It's exciting to me too. Human-centric, client-forward advisor, I think what's so exciting, what I love about it is that it's not just the right thing to do. It is something that you're going to have to do to get away from kind of this generic level of, or this generic offering of financial advice that everyone else can do.
Absolutely.
So I love that answer. Tell us a little bit about you. What brought you into financial planning? What got you into fintech? How did you navigate your career into money advice, client success, this human-centric variation of financial planning?
Yeah. I got into the industry by accident. I graduated from college in 2003 and worked as a server in a burger joint. Met my husband there, so best job I ever had, and couldn't find a job. It was sort of the aftermath of the tech bubble, and my older sister's college roommate had become a financial advisor, and she said, "I bet you could do this." And so that's how I entered the industry. At that time, I don't think there were even any undergrad financial planning programs. I mean, I just had no idea what a financial planner was until I was one. So that's how I got in. But I stayed in because I am at my core a nerd who loves people. And so this profession really allowed me to do kind of both sides of who I am and what I enjoy and where I find flow. And yeah, so that's how I got in. I started in private practice, serving people my parents' age, pre-retirees and retirees, and who is the vast majority of who our industry serves. But at the time, I was in my 20s and entering my early 30s and wanted to serve my own cohort, which I think is probably a pretty common thing for us advisors. And so I took a pivot into fintech, and I worked for Learnvest, which ultimately got acquired by Northwestern Mutual, and ultimately Northwestern Mutual killed Learnvest. But we built an RIA, a digitally forward RIA from scratch that grew to having tens of thousands of clients within 5.5 years. And so we were experimenting with business model and delivery model. And it was a flip from like, we cannot afford, because the fees that our clients were paying us were very, very below market in terms of what we're used to in this industry. We were fiduciaries, no product sales. And instead of saying, okay, well, let's start with everything in the kitchen sink, the 100-page financial plan, the let's go deep in everything, we were helping people in their 20s, 30s, and 40s and starting with a blank slate. And so it really helped me develop sort of this idea of impact weighted work. At the end of the day, if I only had 5 minutes with this person, what is the most impactful thing I can help them with? If I only had 10 minutes, if I could only put one thing on this visual that I'm going to put in front of the client, what would be the most impactful thing that I could put in front of them? And so that way of thinking from nothing, from a blank page, really kind of flip the script on how I think about planning. Instead of editing down from whatever financial planning software spit out, it was just doing it the exact opposite way. And I think because we were an early tech company, but the vision was to figure out what role does a planner need to play and what role can technology play so that we can have the planners have the humans do what only humans can do, and have the tech do as much of the rest as possible so that we can keep pricing affordable and help the masses. So that was the original concept. And I want to say that we were the first in the financial planning space to really do that, to build a digitally forward RIA. There are many since, which makes me really happy. I'm glad that there are others trying to crack this nut. But yeah, that's kind of how I ended up where I am.
Can you reflect a little bit on your experience in fintech and Learnvest and what it taught you about what the traditional industry is getting wrong? And so I love that you referenced impact weighted work. I love that you referenced, you've got to say one thing really strong, really clearly, really well that resonates. And then you basically win the opportunity to say more. And I'm saying it in my own words. But what was like kind of the key lesson that the traditional industry can learn from all of that really incredible and innovative work that you did at Learnvest?
Yeah, it's hard to pick just one, I think. But the concept that client-centric, human-forward, non-salesy, non-product driven financial planning relationships with clients have value in and of themselves, I think was a big piece. I think also, even though we were a tech company, a couple things. One, people really like working with people. Having a human connection to an advisor versus a completely digital solution was preferred by the vast majority of the people that we worked with. So even though, the traditional industry, I would say, helps more of a do it for you sort of demographic. Um, the ideal client for a Northwestern Mutual, for example, is a client who says, I want you to do everything because then you can charge fees on everything and do it all. And the other side is DIYers of like, I don't really want any help, or at most, I just want somebody to check my work once in a while, but I really want to handle my own finances. And at Learnvest, we were a do it with you sort of approach where we're not going to do it all for you. But because we want you to be empowered, and from a scale perspective and a cost perspective, and also that there are enough tools out there and enough solutions out there that clients actually can do a lot for themselves. Um, I think that whole concept of being in that middle space of like the do it with you sort of approach, um, I think that was a big piece of what I learned of like, it's not a do it for you versus a DIYer. There's this middle ground of the client who wants you to do it with them. And there's a ton of value and a ton of demand in that space.
Do you think that there are a lot of tools out there that are doing that today, that are doing the let me do it with you? Or do you think that since that LearnVest experiment, we've kind of now resorted back to the extremes of either DIY or entirely done for you?
I feel like I've seen an explosion of do it with you, sort of like in that lane. Clear winners are not available yet, or are not apparent yet. But I think there's been a ton of innovation there. I think most tech companies try to solve too much with tech and underappreciate the vast array of use cases and edge cases that there are. And so that makes it challenging. I think our old school industry still largely functions basically exactly how it used to. But there are a ton of, I think, both software, like the idea that you would have a client portal. When did all of these softwares start having a client portal or a client sandbox where a client could actually experiment with different scenarios? Those are all relatively recent innovations. And so I think that I think there's been a huge proliferation of trying to get into this sort of middle space of the do it with you, for various reasons. But I do see a ton of movement in that direction, which I think is ultimately a good thing.
I think in financial planning, it feels like even if some capabilities are there, it feels like they're not necessarily being adopted. And I think a lot of that might be the advisor don't know how to strike that balance between do it for you and do it with you. But I agree that it seems like there's a lot of efforts to try to get there and help, and a lot of channels through employers, through a lot of different areas to try to reach somebody and give them support that helps them make better decisions. It seems like still in traditional wealth management, we're not there yet. And I wonder, so you say something that I think might be part of an antidote. You talk about advice that works in real life and not just on paper. And to me, that strikes back to the heart of what we're talking about. You have kind of a financial plan that creates a plan on paper. It doesn't necessarily mean it's going to be adopted or embraced, or you're going to take this advice, or it's going to be impactful to you meaningfully in the way that you are deploying this plan to achieve your end goals. What does that mean to you? How are you actually transitioning the way that you're delivering financial planning so that it's manifested in real life?
That's a good question. I'm trying to think of where to begin with that. I think part of what I developed when I was at Learnvest was this, like, when you're in the do it for you shop, right? If you're doing it for them, they just have to know enough to say, I trust you enough to say yes. And then they don't really need to own it. They don't need to understand it as well. They don't need to feel empowered to do it themselves. You get to just say, like, I just need to earn their trust enough for them to say yes, and then I'll just do it. When you're in this, like, do it with you sort of lane, things like building empowerment and things like helping a client really have ownership over the decision. A lot of what I'm doing is I'm defining a range of good decisions. So it's not a should I or shouldn't I. It's well, if these are your goals and this is the amount of equity compensation you have, then a range of good decisions here for SpaceX IPO, for example, would be to sell anywhere from X to Y. And here's why. This is what X will accomplish for you from a goals perspective and a tax perspective, an investment perspective, and a risk perspective. And here's what Y will accomplish. I think anywhere in that range, you're in a really good place. So it's less about making a plan of, like, do this, or want me to just do that for you. Okay, great. It's more of defining a range of good decisions, because a lot of times that's what people are facing, is a range of good decisions. I think another piece of making it work in real life and not just on paper is seeing goals as an evolution. As soon as we set goals with clients, and we always say, like, goal setting is a team sport. So, like, I want to know what you want to accomplish and what you're working on. I will help you develop those goals if needed as well. I'm also going to put some stuff on your radar if it's not already on your radar that I think would be good for you to consider, if that's okay. And it's like, yes, of course. Great. So goals are a team sport. And then that from the moment we set the initial goals, I set the expectation with the client. I don't expect these to be your goals forever. I expect your goals to evolve. And what's most common with our clients is that once we start to set goals and make progress on goals, then you start to see what's possible and start to think more clearly and get more clarity on what you actually want. And the progress you make on the initial set of goals, or the initial definition of goals that we have, at the end of the day, that helps you put money in short-term, mid-term, and long-term buckets, so that wherever your goals end up, you'll still be closer than you were before. And so we talk about goals as a container to sort of tell how much is enough for one iteration of a goal, but that any progress towards goals is still moving you forward, so that there's not an anchoring of, like, these are my goals, this is my plan, and if you violate that, then you're a bad client. It's like, no, we expect this to evolve. Like, that's what this is. You're going to evolve as a human, what you want, what you need, what you're capable of, what you envision for yourself. We're just going to expect all of that to change because you're human. And that's what the ongoing planning process is iterating together.
What if financial planning wasn't just about numbers, but about you, your values, your goals, your vision for the future? Nomi is transforming client discovery for wealth managers, going beyond assets and risk scores to uncover what truly matters. With behavioral insights and real-time data, Nomi helps advisors personalize advice, build deeper connections, and grow their businesses. Because the best financial decisions start with knowing you. Discover the future of client engagement at nomi.com.
And I know when we first met, I was super excited to connect with you because you do get very much into the behavioral science and you've got this background. In fact, you even embedded it at Learnvest as you were kind of building out those tools back then. What kind of behavioral patterns are you seeing with the groups of clients that you serve? How are you helping them, even in the very beginning instance, to articulate their goals? And what blockers are they seeing? Is that a question that they know how to answer? And how are you using the science to help them?
In terms of, do clients come in knowing their goals?
That could be one, but like other behavioral patterns, when you're kind of just deploying a financial plan, what are you seeing where, the science can help them?
Yeah, so I think one is co-creation is a big deal. So, sort of expanding on that goals idea of like goals are a team sport. And so I'm here to help you develop what those goals are and then make progress towards them and then iterate them as on them as you evolve and life unfolds. Um, I think that co-ownership of the goal, and really it's the client's ownership of that goal, um, that it represents what they want. And so they care about it more and they're more likely to implement the advice because I'm not saying, you really should be on track for at least retiring at age 67. And in order to do that, you need to do this. That sounds like financial advice. It's also much less likely that a client is going to follow that advice than if we co-created the goal and I talked to them about their career and when they might want to be work flexible or maybe work optional. For a lot of our clients, we do a phased retirement where they push like they are now in their career, maybe until 50. And then they are able to be work flexible where they have a lower amount that they need to earn. So does that resonate with you at all? Oh yeah, I love what I'm doing, but I don't know that I can sustain this pace. And so the idea of being able to be work flexible, I really like that idea. Okay, great. Let's put some ages around that. What are you thinking? And so then we're co-creating the goal. And then I can say, okay, well, here's what it takes to get there. When you have that next tender offer, if you can liquidate anywhere from X to Y, that will get you this much progress towards being work optional or work flexible. And they're much more empowered to do it. They're also much more likely to execute because they have skin in the game. It's their goal. It's not the one that I told them that they should have. So I think that co-creation piece, sometimes that's, when a client is maybe spending more than they need to, or spending more than they want to, it might be me taking the seat of, I hear you that you want to reduce spending and that you're right that will help you reach your goals. I don't know, spending 3,000 less a month, that is a lot. I don't know that we should go there yet. What if we incrementalized and looked at trying to reduce expenses by 1,000 a month? And then they're convincing me, no, I can do it by more. And I'm like, no, let's just start at something really doable. So I think when you put the client in the owner's seat, and that there's just a shift and I see them execute so much more often. I'm not begging clients to implement the advice. So I think that makes a really big difference. From a behavioral perspective, we also talk about like a choose your regrets framework. So in equity compensation, there's a lot of big decisions to make of like, well, this could be worth 2 million today or 10 million in 3 years and who knows. So we're dealing with really disparate outcomes. And so taxes, risk, and goals give us a lot of parameters to work within. But we also talk about, it's important to think about like, what would I regret more? I sold more of my Google stock because I wanted to make sure that my baseline retirement was covered. And then it went up versus I didn't sell because I was hanging on because I really wanted the upside. And then it went down. Which one would feel worse? And you get to choose your regrets in advance because even if you make the perfect decision, right? The best, I always say, like, you can only hold yourself to the best decision at any given moment, given the information you had at the time, right? So that's a really important piece. But you can make the best decision with the info that you have available right now, and it still might not work out. You still might go back and say, oh, darn it, I should have held, or I should have sold. But even just something simple like asking them to choose their regrets in advance can be really helpful from a behavioral perspective, to have the conversation in advance to help them be more at peace, regardless of the outcome.
Those are really helpful tips. How do you see, with respect to patterns, that it gets beyond the financial? So we do have a lot of advisors that come on the podcast, and I've also come across a lot just in my journeys where they say, I can't get my client who might be approaching older age, I can't get them to spend money. They're so stuck in their accumulation phase. I can't get them to recognize that now they have a different new opportunity to deploy and decumulate. How do you kind of address that shift where it's not now optimizing for the dollar value that you have in your account? It's optimizing for now live your better life.
Yeah, that's a good question. So I do have retirees that I work with, but they are typically in their 30s and 40s and not in their 60s or 70s. And most of my clients are still working. I work with a different demographic than the vast majority of our pre-retiree and retiree focused advisors. So, but in that case, I think there's a lot of, I listen to a lot of, podcasts and read a lot of articles in our industry about like, oh gosh, I just got to get my client won't spend their money. I think help like understanding why the client doesn't want to spend, which sounds so simple. And it's like, well, I'm scared, right? It's really hard to go from accumulation to decumulation. And so I think things like spending experiments can be really helpful in those situations of like, what if, could you try this one thing this one time and see how it feels? But I guess I also like sort of accept that it is not my job to make the client spend their money. So maybe I see that a little bit differently. If they don't want to spend at the rate that they can spend, they are grown-ups and that can be their decision. It doesn't mean that I'm not going to show them the numbers to say, it would be a super safe spend rate, and, let's brainstorm on your core values and what matters to you at the end of the day. And are there spending decisions that would align with that? And, is this restraint from a budget perspective serving you? Where is it coming from? And is that a healthy place for you? But sometimes it is. So I think I might see that a little bit differently than a lot of people in our industry, because I don't feel like compelled that it is my responsibility to convince somebody to spend all of their money.
There are a lot of people that, especially here in the Bay Area, and I forgot, you're in Southern California? Yes, right?
I'm in Santa Barbara, so I'm
Santa
on the
Barbara.
Central Coast. Yeah.
Halfway between. Okay. So there are a lot of people that are younger that have come into money early. And a lot of that path of coming into money early was fraught with a tremendous amount of risk and risk taking. So there's an emotional component of deeply understanding your clients and their emotional relationship with money around planning, and making sure that as a planner, as an advisor, you're acting as a kind of independent party between them and their own impulses to make sure that their future is okay. How do you dive into that emotional side of money, to their relationships with money, that what got you here might not get you there? Those relationships that you had that, might have been pretty freewheeling and high risk, need to kind of at least leave a little bit of buffer to make sure that you're safe for the future. So how do you kind of dive into that, the emotions, the history, the experiences that they've had, and help them really create the best plan?
Yeah. So for my clients, many of them do come into 7 and sometimes 8-digit numbers, amounts of money in their 30s and 40s. It is not actually always because they were risk taking. It's because they worked at a company they were passionate about, and it either worked or it didn't. But it's not because they took some, inordinate risk. So I think it's a little bit different from like, I started a business myself and put, everything I owned and mortgaged my house. And then the business did well and I had a 8-figure exit. And now what's next? Like that's not the experience of most of my clients. Most of my clients, it's like, I started working at NVIDIA in 2022 and I got RSU grants and they're now worth 10x what they were. So like I got 4 more quarters of like money humming. But it's actually less the case that they would be in the position where, this is because I took risk, and so I'm going to continue to take risk. That said, for clients who might show up that way, I think one of the things that we talk about is range of outcomes, that, we will break goals into baseline goals and home run goals. And for all like baseline or base hit goals, that's like being able to retire in your mid 60s, paying off everything but your mortgage kind of thing. Making sure you have an emergency fund, making sure you can maybe send your kid to a public university or 50% of the cost for a public in-state university, something like that. We will define base hit goals, and then we will define home run goals. And home run goals might be things like, I want to be work optional, I want to be completely like work optional by 45, or I want to buy $1.5 million cabin cash. For a lot of our clients, they cannot accomplish those home run goals without taking outsized risk. And as long as those outside risks, like my company's going to IPO and I want to hang on to 20% of my stock, great. If that 20% of stock is for a home run goal, it's probably your best way to get there. I mean, you might not make it, and you can, from a risk capacity standpoint, if it doesn't work out, you're still going to be fine. But you're not going to nickel and dime, save yourself into retiring at, in 3 years, or buying $1.5 million cat. You're going to need a big windfall for that. So we approach it from like a goals framework perspective differently, to sort of establish risk capacity on the dollars. And that gives us a lot of information as to how much risk it makes sense to take on each dollar moving forward. And even for those clients who are like, well, I did well because I bought, Amazon, Google, Apple, Facebook a decade ago, and that's why I have a lot of money now. Great. However, we need to think about the range of outcomes. And so with base hit goals, those more core baseline sort of goals, we want to be able to predict the outcome. And so with a diversified portfolio, we can better predict the outcome. We can know if you're on track or off track much better, which means that we can then signal to you, I think that you should save another 15 grand a year for that. Or I think you're good with just doing your 401k, or I think it's time to do the mega backdoor Roth. But it gives us enough predictability of outcomes to give you signaling early, instead of, well, you're 64 and you wanted to retire at 65 and it turns out you're super off track. Sorry, things didn't work out. Right. So like for us, that range of outcomes is really critical because it allows us to have more predictive results, which is way more important. And some clients are like, I want that for all my goals. Great. So does that help with that?
I think it does. It really makes a lot of sense. And I appreciate that you really jumped into how you help model scenarios. I love that what you shared about like crafting goals together and getting clients to really feel ownership and accountability. This is not me creating your plan. This is us creating your plan, and us iterating and evolving and shape shifting as you shape shift. And your plan needs to shape shift with that. We always end our podcast with what's an instance in your life or a conversation you've had that has totally changed your relationship with money personally.
Okay, a couple things come to mind. One, so the conversation with money, or the thing that changed for me, when I got married to my husband, who I've been with for 23 years, he like had a core value of generosity. And so giving was non-negotiable for him. And when we got married, he had just graduated from business school. It was 2008. It was not the best time to find a job. He had interned at Apple, but Apple wasn't hiring their MBA class. They didn't hire anybody that year, that following, summer when those graduates graduated. Yet still his commitment to generosity persisted. And so we established that really early in our marriage, that we were going to be generous with our funds. And I am embarrassed to say, but I would cry when we would give away money, because I really felt like we didn't have enough to be generous. I was like, let's just get dual income. Like, let's just get you a job. And I was managing money, right? I was a financial advisor going through the 2008 crash. So it was a really unsteady and really scary time. The opposite of the time that you say, you know what we should do? We should start being radically generous. But his commitment, his unwavering commitment to that, and then my reluctant commitment to him. I mean, not reluctant commitment to him, but reluctant commitment to unwavering generosity because of his commitment to it. It fundamentally changed. Like, I went from closed fist to open fist with money. It changed how I interact with money. It was the most transformational thing that has ever happened for me financially.
I love that story for so many reasons. And there's so many lessons that our listeners can take just from understanding where that comes from, how to iterate, how to learn, how to connect as a couple, how to align, how to really envision money as a tool, how to activate and manifest money as a tool, and not just look at it as a number that you want to keep seeing going up, 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 up. This was a really great conversation, Natalie. Thank you so, so much for your wisdom, your clarity, your focus on human centricity that you have committed your career to, bringing this into the industry. So your work helping planners and platforms alike are a reminder that advice is about people first, and that financial wellness is about so much more than a perfect spreadsheet and a perfect model and a perfect number. Where can listeners find more about you, your practice, follow or bring you in to speak? We have a lot of listeners who are advisors, who run wealth firms, who are just individuals who might be looking around. So what's the best way to get in touch with you?
Yeah, I'm on LinkedIn. I am not obnoxiously active. I post when I have something I think meaningful to share, but not a daily poster. But LinkedIn's probably the easiest spot. And my firm is goodlandplanners.com. We're called the Goodland Group, but our URL is goodlandplanners.com. And we serve mid-career professionals in tech. So that's really our sweet spot. But yeah, that's where you can find me. Thank you for having me.
Oh, it's been an absolute joy. For our listeners, what is a piece of advice that you heard that actually changes how you feel about money? What is something that you have reflected on as it relates to your own personal relationship with money? And how are you going to maybe change the way that you interact with your partner and their different values around money as a result of Natalie sharing her story? Please share this podcast with a friend. If you know somebody who is in that mid-career decision jungle and working at a big tech company, keep Natalie in mind. And thank you for being with us today. Thank you, Natalie.
Absolutely.
Thank you for joining us on the Knowing Me, Knowing You podcast. If you enjoyed this episode, share it with someone who needs to hear it. And don't forget to subscribe, rate, and review. Your support helps us bring more transformative conversations to you. Until next time, keep discovering, keep growing, and remember, you're in control of your own financial story. Follow us for more conversations on financial confidence, self-discovery, and the future of money.